Have you ever browsed the Exness social trading interface and been drawn in by impressive profit figures like 300% or 400%? Or even more? You see very steady capital growth, average risk assessment, and promises of passive income that make you want to jump right into this market. But there's a little known truth. What you see on the screen is just the tip of the iceberg. The hidden part is the underlying risks and the technical and strategic pitfalls. This video is not for those looking for a get-rich-quick scheme or financial miracles. Instead, this is a warning for smart investors and responsible traders who want to fully understand and control their risks before entrusting their capital to someone else. Today, we will break down the biggest risks in copy trading, ranging from fundamental platform issues to the strategic pitfalls created by strategy providers. This is the Exness Market Channel, where we provide the most useful information about trading activities on the Exness platform. We are a leading development partner of Exness. If you're new to Exness Market, make sure to hit the subscribe button to stay updated with our latest videos. If you have any questions, feel free to leave a comment below, and our team will get back to you as soon as possible. You'll find the registration guide and the latest Exness updates in the video description and pinned comment. Besides this channel, you can also visit our Exness Market website to explore more about Exness. To begin, let's talk about platform risks. The first risk is slippage in copy trading. Did you know that your copied orders will never be executed at the exact same price as the strategy providers? When the market is highly volatile, a delay of just a few milliseconds can make your entry price less favorable. This means that while the strategy provider is making a profit, your account could be at a loss or have a significantly lower profit. This is a technical risk that many new traders overlook, but it directly affects the final outcome. Moving on, the second risk is a mismatch in capital and leverage ratios. For example, let's say you have $500 and are copying a strategy provider with $10 in capital. When they open a small position relative to their capital on your account, the opposite is true. It will be a very large position relative to your capital. This increases your level of risk and can lead to your account being stopped out, while the strategy provider's account remains safe. Not understanding capital and leverage ratios is one of the main reasons why many traders lose money quickly when copy trading. Furthermore, we have the third risk: performance fees eroding your account. Many strategy providers set their performance fees as high as 50% of the profits earned. For instance, if they make a 10% profit, you pay a 5% fee. But if the market then reverses and your account takes a 5% loss, in total, you've lost 10% from your peak. Meanwhile, the strategy provider still receives their commission. This creates a paradox where they still profit from fees, while you bear the entire risk of loss. Now let's shift our focus to strategy and provider risks. The fourth risk is the illusion of a smooth equity curve. And this is the most critical risk you need to identify. Many strategies show very steady capital growth and a low maximum drawdown over long periods. However, if you look closely at the trading history, you'll often see no clear stop loss. The strategy involves continuously increasing volume, which are typical signs of holding onto losses and averaging down with martingale or grid-style strategies. This approach can win dozens or even hundreds of small trades in a row. But just one single large loss can wipe out your entire account. This is the most catastrophic risk in copy trading that investors need to avoid. In addition to that, the fifth risk is a short trading history. A strategy might perform very well for a few weeks or months when market conditions are favorable, such as during a clear trend. Yet, when the market becomes range-bound or the trend reverses, that strategy can fail spectacularly. If you start copying during such a phase, you could suffer heavy losses. Therefore, when choosing a strategy, it's crucial to examine a long-term trading history across various market conditions. Finally, the sixth risk is a change in the provider's psychology and strategy. Strategy providers are human, too. When managing a large amount of capital from investors, psychological pressure can cause them to alter their trading style and break their own rules. This can lead to erratic decisions, higher risk-taking, and unforeseen losses. Fundamentally, when you copy trade, you're essentially betting on the psychology and discipline of a complete stranger. And that is never completely safe. So, Those are the 6 major risks you'll face when copy trading. Now, I will provide some solutions to help you become a smart copy trader. The first solution is diversification. Never go all in. You should not put all your eggs in one basket. Instead, allocate your funds to 2 or 3 strategy providers with different trading styles. For instance, you could choose one scalper, one trend follower, and one with a hedging strategy. This diversification will help you minimize overall risk and increase your chances of preserving capital in the long run. The second solution is to utilize the safety net, setting a stop loss. Exness social trading allows you to set a stop loss for your entire copy portfolio. This is your final layer of defense, protecting you from losing your entire account when the market moves unfavorably. You should utilize this feature to control your risk proactively and systematically. The third and final solution is to check the strategy provider's background. Only choose those with a strategy and an operating history of over 6 months, who have weathered various market conditions, and have a maximum drawdown that is controlled under 30%. A long-term track record helps you more accurately assess the consistency and risk management capabilities of a strategy provider. Ultimately, copy trading on Exness is a double-edged sword. It can be a great tool for generating passive income, but it can also wipe out your entire capital if you blindly trust in attractive profit figures without understanding the associated risks. The key is to approach copy trading with the mindset of a risk manager, not a fortune seeker. Understanding these potential risks will help you protect your account and invest more wisely. If you found this video useful, don't forget to like and subscribe to the X Trading channel so you don't miss out on in-depth insights on trading and risk management. If you have ever participated in copy trading, please share your experience with copy trading on Exness in the comment section below. Let's learn and grow together. Thank you for watching. See you again in the next videos from the X Trading channel.